Okay, let's see if this works for us. So hopefully everybody can see what's happening at home if you're watching. And I've got a better microphone this time, so hopefully the audio is better. Hopefully, I'm going to take a quick look. You can see what's on the screen. Turning the light off for me is just a pain in the butt. Most of this you guys will be able to see anyway, so I'm not going to worry about it too much. And you're going to get a copy of everything that I'm giving you, so you'll be able to see everything afterwards anyway. So what time is it? It's just after 9 o'clock. I'm going to make the assumption that people are just going to keep trailing in here. Got about half a dozen people in the room. Hey, Karen. So business valuations. Excuse me. How many of you have been asked to do a business valuation? More than half, right? It's something that we run into fairly regularly as realtors. Our clients believe that we can do this kind of thing, and it's called the Real Estate and Business Brokers Act, so we really should be able to do this from time to time, or at least point people in the right direction, right? So most of you know that I did nothing but commercial real estate for about 15 years and did a whack of business valuations over the years. Only ever successfully sold a few, surprisingly. Here's been my experience. Most people that ask us to sell their business for them, it's too late. They should have sold it years earlier while it was still making money. They wait too long, the business starts to fail, and when they by the time they get to a realtor, it's their last hope. That's my experience. So the vast majority of the businesses I've put a price on in the past ended up folding because they weren't willing to look at reality and what I actually told them the place was worth, because it's almost always much less than they think it is. And I'm giving you this heads up at the beginning, guys, because there's a science to this. There's a bit of an art to it. I kind of like doing a CMA on a house. But there's a misconception out there amongst the business people out there that we can perform magic and get the millions of dollars for their business simply because they're paying us a fee to do so. It doesn't happen. This is a tough thing to do. I think it's important to share. I wanted to give you the methodology because I get asked regularly, can you help me put a price on a business? And I'm more than happy to do that after this is over. If you need help, come see me. I get excited. I get a charge out of doing this stuff, honestly. But there is a process to this, so I wanted you to know what it looks like. Okay. So what are we going to do today? Just an introduction to business valuations. What are they? We'll look at an example process. I've got some spreadsheets that I've developed for you to actually use. So you'll get all this stuff after we're done. But I want to go through the process of actually looking at the numbers. I've got it all pre-filled. We'll just have a discussion about what those numbers mean. And then you can ask me any questions you have and we can go from there. So does that sound good? Okay. Some cautions. I already mentioned overly optimistic estimates. Right? We want, coming from a good place, we want to give our sellers the most money we possibly can, right? We want to say, yes, we can go to the market and get you this big number for this property, but the reality is it's often far from the truth, right? So being overly optimistic is a big caution. Usually you got to cut your number almost in half, honestly. From the first initial thought, oh, this is worth $1 million. No, it's not. And we'll talk about how to do that. Not using actual reported income and instead going on what they tell you. Oh yeah, I made 80 grand last year. Okay, well, we're gonna use a rule of thumb, one of my other cautions here, and we'll call it 3 times the income, so your business is probably worth 240. Probably not. Probably not, okay? So you gotta make sure that you get some actual financial statements. Handwritten notes on the back of a piece of paper is not a financial statement. Okay, Sean?
Does it have to be audited, or can it be?
No. It doesn't have to be an audited set of statements, but I would hope that a serious business person has an accountant doing their books for them, right? So they should have, and we'll show examples here in a little bit, of an income and expense statement. They have different names now. Some of the accountants are calling them different things, but it's an income and expense statement and a balance sheet. Those are the things that are important to me. You might also see things like a statement of cash flows. You might see all the notes associated with the financial statements. It doesn't really matter for you guys. There's just a couple of things you need to look at on a balance sheet, and you need to understand an income and expense statement and how to reconstruct them. So that's what we're going to talk about mostly today. Audited statements aren't required until you're over a certain size. When you've got revenue over, I don't know, $5 million or $2 million, something like that, then to file your taxes, the government's going to say you need an audited set of statements. And I don't know the exact number. It's something like that. But most of the businesses we deal with through real estate are not that large. Okay, occasionally they are, but not often. Okay. You guys have heard of these rules of thumb too, by the way? 3 times the net income, 2 times the gross revenue, 5 times EBITDA. There's all these different phrases that you'll hear out there. They're almost always wrong. They are close. They are estimates. There are rules of thumb. They work some of the time and they get kind of close. So that's why they exist. That's why we have rules of thumb, but they're not really accurate. Okay. So the methodologies that people use to come up with values for business, they'll use multipliers. Multiples of sales, multiples of net income, multiples of EBITDA. Do you know what EBITDA stands for?
Expenses before
It's earnings before income taxes, depreciation, and amortization. Okay, so it's a fancy number that people use a lot in share sales. When you're looking at a company, you want to look what is the actual earnings before all these numbers. Because when you take out earnings before income taxes, depreciations, and amortization, those are all fake numbers. What's the business actually producing? Then we'll take out the taxes and whatnot later. What's the actual cash coming out of it? So that's EBITDA, okay? And stabilized income. And that's really what we're going to use today, and we'll talk about that some more. You can look at comparables. When you're putting a price on a house, you can look at other houses like it that have sold, and you can say, well, this house within reason is worth X dollars, right? We do it every day. You can do that with businesses. If they are very, very similar in very similar markets with very similar income and expenses, then you can say, oh, that one sold for $500,000. This one's probably worth $500,000. It works. Excuse me. But it's not often used. It's sometimes used as a starting point to narrow in the choices, and then you will get more specific looking at a business valuation, okay? And the other one is asset value. If you've got a business that's not producing cash, or it's been shut down for a while and they want to try to sell it, it's the asset value. What is the stuff they've got left over, right? If it's a widget factory, they'll have some machines that build the widgets. They'll have some desks and office equipment. They'll have maybe some point of sale devices. They'll have maybe some vehicles. Those assets still have real value. So you look at the asset value of that business rather than the cash flow, because there is none. Does that make sense? Okay.
Should we be able to see the difference of that on a listing on Matrix when it's just the assets?
I would hope so. But you often won't,
Yeah.
and here's why. And this is not a slam against realtors in general, but there are only 4% of realtors that do commercial real estate on a regular basis, okay? And even of those 4%, probably half of them don't do it right. To get proper information out to a potential customer, you have to share this information. But often you will see a listing out there that has the price, what the business is, great opportunity, and that's it. And then you'll call the listing agent and say, have you got a set of financial statements? No, we haven't got those yet. Well, when can we expect it? Well, the accountant says he's working on it. And you never ever see it. Well, can we get a copy of the lease? Well, it's just a handshake deal. Well, have you got a value of the assets? No, it's his truck and some tools. So it's really tough to get this information. I would expect if you're going to do your job correctly, you would have all that information available. Okay, so it's one part of that questionnaire that you should have when you're going out to speak to a potential client. I need this information. Okay, good question. So a derived value approach is what we're going to be using. That's not a real name for it. That's just kind of what I call it. We're going to look at the value of the assets and a premium for goodwill if it deserves it. If it deserves it. If I have Doug Lytle's carpentry business and I make $100,000 a year in net income, does that business really have value if I go away? If Doug Lytle stops working in that carpentry business, is there any value in Doug Lytle's carpentry business? No. The answer is zero. It might be worth 10 cents on the dollar what I paid for those assets. Maybe. Okay? It's too easy for someone else to come in and compete. So there is no goodwill. Goodwill is something that you'll see in Coca-Cola. They're worth 16 times EBITDA, right? Or 16 times earnings. They've got these big valuations because they have lots of goodwill. That company will exist when I'm long dead, right? That's got goodwill. These small businesses, you can attribute a little bit of value to excess earnings, but not as much as you think. So if someone tells you, oh, it's 5 times the earnings or 5 times the net income, no, it's not. And we'll get to that, okay? This is not a share sale valuation, okay? There's a number of extra variables that go into that. This is a typical small business where they're just selling the assets. So here are the steps. It's typically 7 steps, and I've got this great package I'm going to give to everyone. I'll make sure you've got either a hard copy or a digital copy of this business valuation that Century 21 puts out. It just so happens it's very, very similar to the methodology I've always used which was great. It's only 7 steps. So I added my own number 1. They start at number 2. My number 1 is I want to see if the income stream is stable. So I'm going to ask for several years financial statements, 3 to 5 years of financial statements, so that I can look at the trends. I want to see, is this business growing? Is the net income rising? Are the gross sales rising? Are the expenses stable? Is there anything unusual? Is it varying year to year wildly? I want to see the trend. If the business is stable or growing, it's got more value than a business that's erratic or declining. Would you agree with that? Yeah. Okay. So step 1, check to see if the income stream is stable. Number 2, prepare a broker's reconstruction. This is what Bill Pyle taught me years ago. This is what we call it, a broker's reconstruction, also called stabilized income. We're going to look at this year's income and then project it to next year if someone else was running the business, given normal growth in both revenue and expenses. Okay, so that's the stabilized income. What would it look like if someone else ran that business? And we're going to make some educated guesses, but they're based in reality. Okay.
Sorry.
Yeah.
What's stabilized? What's normal growth? Like, how do you determine the normal?
I use inflation. Typically use inflation, right? Or if you can look at the trend line of the business and it's a straight line trend and they've been growing by 5% a year, 5% a year, 5% a year, I'm going to use 5%. If it's kind of stable and maybe slightly growing, I'm going to look at inflation. So what's the underlying inflation rate? Between 1.9 and 2.5% generally. Bank of Canada and the government of Canada try to keep inflation around 2% a year, right? So I'm going to use that number typically as my growth rate if it's a stable business, okay? That doesn't mean that a new buyer wouldn't, really have some new energy and really grow the thing quickly. They might double the business the first year, but I can't forecast that. That's unreasonable. So I have to use real numbers to come up with a valuation of what it's worth today, not what it will be worth 2-3 years from now. Does that make sense? Okay. Determine the value of the tangible assets, and there's an easy way to do this. It's called the balance sheet, and I'll show you how to get that information from the balance sheet. Determine the cost of money, and I've put in here the opportunity cost. So if I had to buy the assets of a company, it's going to cost me some interest on that, right? I've got to borrow the money typically, unless I'm paying cash for it, which is now my opportunity cost. That cash, if I invested in a stock or a fund or another business or a piece of real estate, it would earn money, right? Hopefully. If I invest that money in my business, it should earn money, right? So there's a cost to me. I'm loaning money essentially to that business. I should get a return on it. Or if I have to borrow it from someone else, I have to pay interest on that. Does that make sense to everybody so far? So to buy the tangible assets of the business, I've got to borrow that money from either from myself or from the bank, and there's a rate of return attached to that. So I'm going to determine the cost of the money. What's the cost to borrow that money? I've got to determine the excess earnings. So what's left over at the end of the day after the business is running and paying for itself? What's the excess cash left over after I pay that cost of money? Calculate an appropriate multiple for excess earnings. And the key word here is appropriate multiple. It's not 3, it's not 5, it's a number between 0 and 6. Typically for a small business with an asset sale, there's a number of steps and we'll go over how to do that, okay? Calculate the value of the excess earnings, and finally determine the total business value by adding the value of the tangible assets, the value of the excess earnings together, and coming up with a final value for the business. And this works whether there's real estate included or not. So are we all on board so far? Okay. Where do you get your data? Financial statements are your friends. Don't be intimidated. I know you're not accountants. Some of you might have a banking background. We're not accountants, and I don't expect you to be. I don't expect you to be able to strip down a set of financial statements and understand it backwards and forwards. But I do expect you to be able to look at an income statement and a balance sheet and pull some basic information, so I'm going to show you how to do it, okay? Excuse me, Randy, your cough is contagious. So here's a very simple balance sheet. So I don't know if you can see that very well here, but you're going to use the balance sheet to find the book value of various items. The balance sheet is basically an account of all of the assets of the business, all of the liabilities of the business, and we call it a balance sheet because the two sides need to balance. Okay, that's why we call it a balance sheet. Don't worry about that too much. I want you to look at a balance sheet as a tool to find information. Okay, so you can find right in the balance sheet at the end of the last reporting period, what was the value of the inventory? So if it's a manufacturing business and they have plastics and they've got connectors to put some wires together, those assets, that inventory has some value, right? So it's recorded in the balance sheet. Inventory, land, buildings, equipment, cash on hand. Those things are all in the balance sheet. Now, it's a snapshot in time, granted, for that when the statement was prepared, but it does give you a good idea of what the business generally has on hand in terms of assets. Any questions on that? Is that making sense to everyone? Okay. It's also used to gauge the health of the business. The balance sheet there's some really neat things in here, and the one that I always go to first is called an acid test. Who's heard of an acid test? It's also called a quick ratio. Anybody heard of that? Okay. So if I had to liquidate my business and I had to pay off all of my debts, would I have any cash left? That's the acid test. If I don't have enough cash and assets in the business to pay off my debts, I'm in bad shape, right? It's like it's being underwater. If, back in 1990, you had a house that was worth $200,000, but your mortgage was $300,000, you're underwater, right? A business can be underwater too if they don't have enough current assets to pay off the current liabilities, right? It's very similar thinking. So on your balance sheet, under assets, you'll see various headings. And one of them you'll see here, it says total current assets. Everybody see that? It's on every balance sheet I've ever seen, total current assets. And it's got a value attached to it, and it's a sum of the current assets, cash, accounts receivable, inventory, excuse me, and prepaid rent. These are all easily converted to cash, right? Even accounts receivable are convertible to cash. I can call a collections company and say, look, I've got $200,000 in receivables. Give me $100,000 for it, and it's yours. So there's some value to it. I'm not saying that you cut the value in half here, but you can say those receivables have value. The money just hasn't come in yet. Okay, so that's total current assets. In this example, it was $175,000 in current assets. Now I go to the liability side, and I'm going to go to current liabilities. So it's accounts payable. What do I owe in cash, right? Taxes payable, salaries and wages payable, interest, and there's total current liabilities. So the total current liabilities in this example are $140,000, right? So if I divide one into the other, if the number is 1 or higher, I'm safe. The higher that number is, the better off I am. So what's 140 divided by 175? Or 175 divided by 140?
Which way?
Do it both ways. I didn't do the math.
140 into 170 is 0.8.
So do it the other way. It's 1.2. If it's 0.8, it's 1.25.
Divided by 140?
Yeah.
1.25.
1.25. So 1.25 is the quick ratio, the acid test. It tells me that if I had to liquidate this business tomorrow, I could pay off all of the assets and still have 25% of that cash left. I would still have money left over. I could liquidate the business and not be bankrupt. Okay, so that in this example, the acid test is good. Excuse me. I've seen some businesses where it's 2, 3. They got so many assets and very little liability. That's a healthy business. Anything over 1 is good. Get over 2, you're golden. Okay. Questions on that? I know we did it quickly, but we got a lot of material.
That's based on like a date.
It's a date. It's one date and time. So typically what you'll see, and this is a very simple balance sheet, typically you'll see 2 columns, this year and last year. And when I'm looking at these, I will look at, again, I'm looking at a trend. If I can get more than 2 years, fantastic. And I will look at the trend line. Are the receivables stable or are they rising? If the receivables are rising, I've got to get on my account managers and say, get the money in here, right? If the current assets are rising, but the current assets are dropping, but my liabilities are climbing, then my costs are out of control. So I've got to keep on this thing all the time. A prudent business owner will be looking at this every month. Every month they'll look at a monthly statement and then their annual statements, and then look at the year over year. Okay, but it is a snapshot in time. So this is a very simple income and expense statement. So this shows revenue in, expenses out, net income. Pretty straightforward. You guys do this on your taxes. Every single year when you do your taxes, how much gross commission did I earn? What did I pay in split fees? What were my expenses? What's my net income? Right? So this is familiar to everybody, I hope. This is just more formal when you look at it for a business, right? So the business isn't the person doing personal income taxes. The business has its own statement of accounts. So you're going to use this to find the gross income, the cost of goods sold. I'm selling widgets for $5 and it cost me $3 for the materials. That's my cost of goods, the $3, right? So that's in this sheet. The gross profit, other expenses of the business that are more variable, and the net income. Comparing year over year, again, will give me the trends. If I notice that one year my revenue stays stable, but my net income drops, I'm going to go looking, hunting for that expense number that went up that year and why. Okay. So when you're filling out and doing your business valuation, you're going to start with this. Okay. And again, to do a proper evaluation, you need at least 3 years. 5 is better to do a proper evaluation. Okay. Now I'm going to jump into my spreadsheets here so you can see the example. Can everybody see that? I grow it up to here. Make it a little bit bigger. Okay. So this is that stabilized income that they talk about, or excuse me, the trend line, the number 1 step that I added here. So what I've done here is I've used the example out of the package here for the first column here to see what's this year look like, right? And then I've made these numbers up. I just went backwards in time and subtracted a percentage just to have something on the sheet so you can see what it looks like. To show the trends, I'm looking at this sales number. So going forward in time, in this direction, are the revenues going up? And they are. They're going up at a fairly stable rate. Are the expenses going up at a stable rate? Yes, they are. They should be. If my revenue is going up, my expenses should be going up nominally, right? And at the bottom is the net income, the indicated pre-tax profit. Is it rising? And it is. So this business is fairly stable. It's growing nicely at about 2 or 2.5% a year. So this is something that, to me, if I was starting my analysis and looking at this, I'd say we might have something here. Sean.
Quick question. If you're looking and saying there's a drop in a year or two while you're going back in a 5-year projection, do you take that into consideration? Let's say somebody was sick and they were away from the business. Like, how would you mitigate that aspect when you're doing this?
Exactly that. So I hope everybody can hear. I've got another mic on the back of my phone, so hopefully everybody can hear. But Sean's question was, what if there's a blip? So I'm looking at these statements, and maybe 2 years ago, this number dropped down to $20,000 because something was off. The revenue was down or the expenses were high. It's usually because the owner was sick or there was an economic downturn or some other outside factor that took control. The Trumpster puts on a tariff on metal and you can't get steel in a proper cost, so your expenses go through the roof. There's usually something like that. So if you see that, the first thing you do is have a conversation with your client. So I'm doing an analysis here, Mrs. Seller, and I see that your expenses went through the roof 2 years ago. Do you have an explanation for that so that I can account for it in my evaluation? If it's a one-time thing, I'm going to ignore it. I'm going to reconstruct that year to make it look more normal to see what the trend should have been. Okay, good question.
And then disclose the fact that you did that.
Oh, absolutely. Absolutely. If I'm going to give anything to a would-be client in the future after I've done this, all over it, it's going to say, this is not a financial statement. These are broker reconstructed numbers only. And I will provide them with the real numbers as well. If the seller has given me a package of their actual financial statements, they get that in addition to my evaluation, okay, or my reconstruction. The seller may not want me to give out my reconstruction, right? That reconstruction is for illustrative purposes for the seller when I'm putting a value on it in the first place, or for my buyer if I'm doing an evaluation on behalf of a buyer. One or the other might not want me to disclose that information. So, you got to have that conversation with your client. So does this make sense to everybody? Okay. Just looking at the trends. Calculation of stabilized income. So this is what they're talking about before. So let's take a look at this. So the first year on the left-hand side here, the actual numbers that were reported, right? This is all the actual numbers for this made-up business, okay? So they've got $650,000 in revenue. They've got $197,000 in change for cost of goods, $187,000 in operating labor for a gross profit of $265 and change, okay? In the next year, if I jump ahead a bit here, I've projected an inflationary increase, okay? And the spreadsheet, by the way, guys, I've set this up so that you can put in the inflation rate and the system will do the math for you, okay? So when you get copies of these and make copies of it to use in your own Google Drive, anything that's shaded yellow, you can mess with. Leave the rest of it alone, okay? So I've put an inflationary increase on these numbers here. And you can see right here, these expenses are based on a percentage from last year, a percentage increase from last year, okay? Below that, these are the real expenses in our fictitious company for the business. So sales expense, that could be salespeople, right? It could be other materials that they might need. There's an administrative expense. You've got to have somebody running the office, right? And materials to do that. Executive salaries. You see that $40,000 number? That's what the owner paid themselves on, at least on the books, okay? The executive salaries. When you go to project this for the following year to do a stabilized income approach, you need to put in a real number that if you had to hire a manager to do that job, what would they expect to be paid? It's not what the owner will take, because the owner has some other tax benefits in owning this business, right? And some other perks and some, the lifestyle and whatnot by owning the business. But if you had to pay someone to do that job, it's probably more, right? You probably have to pay them more money. So put in a real number. What would I have to pay that person? I said before, if it was Doug Lytle's carpentry business and Doug Lytle went away, the business has no value, right? For a business, the way I look at it and the way this evaluation works, the business has value if someone else can step in and run it and there's still excess cash. If there's still money left over, now I got something that's worth real money, okay? But if I can't afford to put somebody else in to run that business, am I buying a business or a job? I'm buying a job, right? And that's not bad. That doesn't mean it's the wrong thing to do. You get job security that way because I own it, right? I own the business. I own my job. I'm not going to get fired. So that's okay. But it's not as valuable as a business that I can have someone else run and I can go to Tahiti while they run the business.
You might get fired if your business fails, because I can't make costs of the way I'm leasing. Imagine I just go in and then it's like the business would fail. My cost is not good.
Yeah, so she wouldn't have hired you. Right? She wouldn't have hired you. So running that business means I've got to get the right people on the bus, right? Sean?
How much of a brand do you put, how much money do you put on the actual brand of the business? Like the
Big fat goose egg. Zero. Brand is worth nothing unless you are IBM or Coca-Cola, Pepsi, right? Apple.
Like just in terms of like the community itself, there's a smaller.
Zero.
Perfect.
Zero. Unfortunately, guys.
No such thing as goodwill.
Yeah. There is a multiple of excess earnings, but goodwill is something it's a made up term and it's just not a real thing. Okay. It's a word we use to describe the value of excess earnings, but goodwill is, unless you're the Sisters of St. Joseph, you don't have much goodwill. Right? So does this make sense to everybody? And you can see there's some variable expenses here. I've tried to just, make up numbers that might be more representative of reality if someone else was running the business. Okay. And looking forward to last year, there were some unusual expenses. So depreciation, that number goes down unless I add new equipment to my business. Depreciation is a number based on a declining balance. So the depreciation number should get smaller every year unless I add new equipment, because that's how depreciation works. Maintenance and repairs, I added more here because I took a look at the property and they hadn't done enough repairs and maintenance on the property. So I'm going to up that going forward to make sure that the property stays in good repair. I made that up, but that's why I did that. So at the end of the day, I see here my stabilized incomes are actually quite a bit lower. So the actual numbers that were reported were 63,900. My stabilized income comes up at 52,000. And you'll find this is typical. When you do these reconstructions, your numbers will come up lower often. Okay, that's okay. Excuse me. The seller might not like it, but it's reality. Okay. Questions on this? You guys want to see what happens when I change the inflation rate? So we're in Colombia and the inflation rate goes to 100% or 1,000%. Just to 100%, and then watch the numbers change. Oh. Look at it. Gross revenue goes to 1.3 million, and the other expenses, because they're based on real percentages from the year before, also rise. But net income goes way up, right? So that's if you know the real inflation number, and Bank of Canada the government of Canada puts out the real inflation rate, you can plug it in there. I years ago did a running average, and it almost always, on average, 2.15%. So that's why I use that number in here. Okay. Questions on this? So this is the reconstruction. Okay. Now we're going to use this information in the next step when we continue to put the value on the business. So the next step in the list, number 2 on the list, number 3 on the list, is the value of the tangible assets. So I said we're going to look at the balance sheet, right? We're going to refer to the balance sheet and or your CMA. So the balance sheet will have a value for things like land and buildings. But if they bought the thing 20 years ago, This is going to be the land value they had on it to begin with, because land doesn't depreciate. But the building value is going to be depreciated over those 20 years. So it's not going to be a real number. If you take those two from the balance sheet, might not be correct. Okay? So you're going to have to do a CMA on the land and buildings and plug those numbers in here. So if there's real estate included, you've got two jobs. You've got to put a business valuation and the land valuation. Everybody clear on that? Okay. Inventory comes right off the balance sheet, right? Especially if I've got 2 or 3 years of history, so I can prove that it's pretty stable at that number, right? So I'm going to use that number. The equipment number, again, comes from the balance sheet. They've got a valuation for their equipment on there. And I'm using those numbers from the balance sheet, even the equipment number, which is depreciated, because if they had to liquidate and sell that equipment, they're not getting retail value for that equipment, are they? Right? I bought a tractor for $100,000 and I use it for 5 years. On the books, it's now worth $25,000. Am I going to get $100,000 for it? It's not worth $100,000. It's worth 25 because it's depreciated. So those are real numbers. And the working capital required, cash on hand from the balance sheet. You got to have cash to run the business, right? There's no business runs on air. You have to have cash in the bank to run any business. Even you guys, when you're running a real estate practice, you need to have a line of credit for lean time so you can continue to market, right? You got to have cash on hand. Excuse me. So the total tangible assets in this example is $300,000. Okay. Now we have to discover what's the cost of money. If I have to borrow the $300,000 or I have to put my own cash, my own $300,000 into this business, what's the rate of return I should expect to get or have to pay on that money? Okay. So what's the cost of money? So that we start with the value of the tangible assets and then the underlying interest rate. So you'll see an example when you get this handout eventually, an explanation of what the underlying interest rate is. It's just a way to calculate what would it cost to borrow that money, or what's a real number that I should expect to get. And it's usually about 4% higher than the rate of inflation. Okay, just here's a rule of thumb, but it works. This one works because as interest rates float up and as inflation goes up and down, interest rates go up and down, right? So this kind of works. So using 6.15, because it's 4% higher than the 2.15 I inserted on the previous sheet. If I change that other sheet, if I change this to 4, and then go back to my cost of money, it now says 8. It does the math for me. So don't worry about having to figure this stuff out. The system will do it for you. Okay? I'm going to put this back. So if I had to borrow $300,000 at 6.15%, my interest costs is $18,450 a year. Make sense to everybody? Okay. Next steps. Value of the excess earnings, or excuse me, what are the excess earnings? So on the first page, when we did the calculation of stabilized income, right, the broker's reconstruction of income, I showed it was $52,000 and change, right? $52,206 based on the assumptions that I made for the coming year. Remember that? From that, I have to take the cost of money. What's it cost to run the business? The interest cost on that cost of money. I have to subtract it from that because that's cash out of my pocket. It's gone, right? I'm either paying myself that money separately or I'm paying someone else. So it comes out of that excess cash flow. What's left is excess earnings of $33,756, also sometimes called discretionary income. Have you heard that term? Discretionary income? Okay. With me so far? Here's the fun part. Here's where a little bit of art and science clash here. The excess earnings multiple. Now that we know what the excess earnings actually are for our fictitious business based on our stabilized income, we have to now come up with what's a reasonable multiple of that number that we can apply to see what the value of that excess earnings is. Okay? So you hear people use, 3 times multiple, 5 times multiple. It's actually something you can derive. And it's different for every single business, okay? So in this example, we're looking at the risk rating, competitive rating, industry rating, company growth rating, and desirability, okay? So let's start at the top, the risk rating. Use 0 if the continuity of the income is at risk. If the owner goes away and the business dies, this is a 0, right? If it's totally dependent on one person, it's a 0. Don't put a multiple in here. Don't try to be generous. Okay, you have to be realistic with this stuff. 3 is it's steady income is likely. You know, the business kind of runs itself. There's a management team in place. There's fantastic staff and salespeople there that keep things running, right? Growth income assured would be a 6. So if it's, you just know this is a new industry, you're in the ground floor and all the pundits are saying this thing's going to explode, then you can use up to a 6. Okay? In this example, they used a 4. Competitive rating. So highly competitive in an unstable market would be a 0. Who can give me an example of a highly competitive business in an unstable market?
Marijuana.
Marijuana. Yeah. Highly competitive, very unstable. Nobody knows where it's going, right? Normal competitive conditions would be a 3, right? And 6, little competition in the market, high cost of entry for new competitors. Give me an example of that.
Restaurant.
Actually the opposite. Little competition in the market, high cost of entry. So little competition in the market might be luxury cars, right? If you're talking about a Bugatti dealership, it costs a ton of money to get into that. There's not a lot of competition in this marketplace for those cars. So that might work. See you, Sean. Your business is quite competitive. In real estate, the multiple, if you were trying to sell your practice and you were going to apply a multiple, probably a 1, because it's so competitive. The market's fairly stable right now, but we don't have a crystal ball about real estate. It's very dependent on the economy. So I would be not using a large number for real estate sales reps for this exercise.
Sorry.
Go ahead.
The first one, what is it?
Risk rating, the first one?
For a real estate agent would be 0 because as soon as you walk away, right?
Yep. For a sole practitioner. If you've got a large team that's running well and you've got systems in place and you've got your manuals in place and then the owner, quote unquote owner, the team lead can leave for a month or 2, then continuity's there. The risk rating is lower.
Is another story, right?
Absolutely. Absolutely. Industry rating. So if the industry is declining, you're going to use a low number. So coal. If I was in the coal business, there's no multiple for the industry rating, right? Dynamic industry, rapid growth likely. Internet security, information systems, that kind of stuff, that's a high multiple, right? Because the industry is growing and it's going like crazy. Company rating. It's a recent startup or it's not established, 0. There's no multiple of income. Well established with satisfactory environment. So this business, well established, satisfactory environment, pretty good environment actually. It's probably a 3 or a 4 for this part of the rating. If it was a long record of sound operation with outstanding reputation, Coca-Cola, IBM, Ford, right? Those companies, high multiple for this. Company growth, declining growth. So back to that first sheet we looked at the income trend over time, right? If that number is going down, you can't use a multiple for company growth. You gotta call it a 0. If it's explosive growth in customer base and employee pool, then it's going to rise. So again, new industries, new tech, that stuff tends to have, like biotech, it's growing like crazy, so you'd use a 6 here. Desirability, there's no status, it's rough or dirty work. The multiple is usually a 0. Respected business in a satisfactory environment, you're going to be in the middle of the road at 3. If it's a challenging business, something that you can really get your teeth into and it's exciting and people like to hear about it, and it's a really attractive environment, then you're going to use a higher multiple. Okay, so in this instance, you can see the numbers they plugged in. They guessed for this business, plug those in, and at the bottom in the green box is an average of those 6. Right, so there's 6 factors that you're looking at on a scale of 0 to 6, and then you average them out to come up with the multiple of excess earnings, to come up with the value of the excess earnings. Make sense to everybody? Kaya, you look like you have a question.
Oh, just math is not my best friend, so, and it's early, so anyways, it's all good.
Okay.
I'm with you.
This is a big number too, by the way. For most small businesses, anything over a 3 is a big number. Just my experience tells me people are very overly optimistic when it comes to these multiples and their ratings in each of these scales. Again, we do it to ourselves because we want to be generous and kind to the seller. So we tend to put high numbers on these things. You need to be ruthless with this, or you're just not going to sell that business. I speak from experience. Okay. All right. Putting it all together, total business value. So the value of the excess earnings is the excess earnings less the cost of money times the multiple. So the excess earnings is here, the multiple. And so we're saying in this instance, the value of the excess earnings $132,000. So this business is earning over $650,000 a year. It's only worth, the cash flow is only worth 130 grand. Okay? Which would be counterintuitive to a lot of people. They would look at that and say, that's gotta be worth some money. Not really. And that's generous.
So if it was just a mom and pop kind of business, would you even, like, as Harry said, there's no point in doing the goodwill, would you still do that?
If it fits those other categories, if it's very desirable, if it's in a growth industry, if the company itself is gaining customers and gaining market share, there is some value to it. It's just, you can't put a multiple on the growth factors, some of those growth factors. So I would look at the risk rating, I would put a 0, right? Because if I go away, there's a risk that goes away. The company rating would be a low number, right? So it's going to be reflected in the multiple that you choose because you're going to average those things out.
All right. So you would do it and the goodwill would just.
That quote unquote goodwill, and you see I got it in quotes, that quote goodwill number gets smaller, that's all. Because when it's a mom and pop operation, there's nothing wrong with that. Those are the backbone of our economy. Excuse me, but you're buying a job. You're not really buying a business, you're buying a job, and there's some value to that. And somebody built it up to the point where it's producing income, so they should be compensated for that. But it's not as big as you think. Or they think. Okay? And it's often your job to be the referee, to stand in the middle and to negotiate this. The last business I sold that had real estate attached to it was a convenience store in Lindsay. And I had a seller that was really hard on his price, and I had a buyer that was really hard on their price, and it became a joke. They were making jokes about fighting each other because it was a grind to get it done. It was give and take on price and terms and price and terms, and it was a battle because they both have hard opinions on what that value should be. Our job is to stand in the middle and help them negotiate that out. Okay? So the total business value. So now we know what the value of the excess earnings is. Now we have to add in the value of the assets. But if you're paying attention, you'll see the value of the assets is not the $300,000, it's $260,000. Because the cash is not something that you buy. Cash is something you have. So the assets in this calculation don't include the cash on hand. The buyer would have to have that cash in their pocket when they buy the business to continue to operate the business. But I'm not going to pay you $40,000 for $40,000. That doesn't make sense. It's cash for cash. So you pull out the cash on hand from the balance sheet and from the value of the tangible assets when you're putting the value on the business. Does that make sense to everyone? Okay.
So these numbers all auto-populate on this page?
This page auto-populates.
Okay.
Yeah. You don't have to do anything here. Yeah. So I just want to go through it so you understand where they're coming from. So any questions on that? So at the end of the day, this is the final value of that business because it's got real estate attached to it. If it didn't have the real estate attached to it, it would be worth $140,000 less than that in this example.
So if there's a lease, where
Yep.
does that
So if there's a lease, good question. It would show up back here.
on where it's
It's going to, no, the calculation of the stabilized income. It would show up here as rent, right? You would have no depreciation expense or very little depreciation expense.
Yeah.
Your equipment and assets like tables, chairs, your widget maker, whatever it is, those things would depreciate. So you might have a smaller number there, but you're going to have a rent figure here. Okay. So that's where it's accounted for. And then on your balance sheet, you would the lease is not on the balance sheet because it's an expense. Balance sheet covers assets and liabilities, but rent is not an ongoing liability. A liability in terms of a balance sheet is I bought this for $1 million and I got to make payments on it. So there's a liability attached to that. It's an asset and a liability. Rent is just an expense. Okay. Any other questions? So you're going to get this spreadsheet, or the sets of spreadsheets, and you see while I was working on this, I just went across the tabs at the bottom, right? So the very first tab is the year-over-year comparisons. So you're going to take the income expense sheet that you're given and put in those numbers for the various years that you're provided with. Okay, so if you're only given 3 years, you just ignore that last column. Just don't fill it in. Okay, so start most current and work your way backwards this way so you can see the trend across time. Okay. If you only have 2 years, you only have 2 years. You got to work with what you got. So just fill in 2 columns and try to see if there's the beginnings of a trend.
So going back to your point, like if a business is not willing or doesn't have this and it's all just scratches on paper, then you should just not even work with them. Like,
It's nice to meet you. And as Rob Vivian says, I like you and I like your dog better. Have a good life. I'd walk away.
Yeah, because you got nothing to go on.
Yeah, there's nothing to sell.
Yeah.
And in addition to that, there is a regulatory requirement for you to provide a bit of information when you sell a business. So on the heels of this, you must provide, from a legal perspective, a set of financial statements or an affidavit explaining why there are no financial statements for that business. That's a legal requirement. And the second one is a list of exclusions. You must describe what is not included with the business. Weird, but that's the way it works. Okay, so when you're putting your documents together, those are the 2 things you have to have.
And sorry, another question on the buying side, if you're helping a buyer, but you kind of want to go through similar practice, I guess.
Mhm.
Sometimes you can't get that information until you put an offer in or something, right? And it's based on being provided with the,
Yep, and I would say that's an inexperienced realtor
okay,
who really doesn't know what they're doing.
okay,
How can I make an offer on a set of cash flows if I haven't seen those cash flows,
yeah,
right? Because that's really what they're saying. If I was going to buy a duplex or a triplex and they wanted $600,000 for this triplex, if I don't know what the income is, how can I justify paying $600,000?
yeah.
Right? So you've got to have that income. It's the same in businesses. It's a little bit worse. It's harder to get this information from people sometimes. And if they say, we'll give you the statements after we get an offer from you, thanks. It's nice knowing you. I like you and I like your dog better. Like, move on. It's not going to work out. Okay? If they say, well, that's private, I'm not going to just give that to anybody,
You can sign that.
I totally understand. I'm happy to sign a confidentiality agreement. I promise not to divulge that information to anyone outside of my advisor circle.
Right, okay.
Okay? Other questions? Okay, so you're going to get these spreadsheets. You're going to get this valuation summary, and I'm happy to give you my little slide presentation if you want it, so you can see the examples. Okay? All right, thanks guys. Hope it was informative. You're welcome. Thank you.